Hi, everyone. Thank you so much for joining us today. Sorry, we are getting started a couple minutes late here, but we will jump right in, go over some housekeeping items, and then we will go ahead and get started. First and foremost, if you are here for CPE credit, we do need you to do a couple things in order to receive that CPE credit. You will need to answer the poll questions as they pop up on your screen, and you will also need to fill out the survey at the end of this webinar. That survey will pop up for you as you are exiting. It will also be emailed to you in 24 hours. So again, you have to do both of those things in order for us to award you the CPE credit. A couple other important things to note here. As we are going along, if you have questions, please reach out and ask those questions. If you just wiggle your mouse around, you'll see a Q&A button. You can send us your questions at any time. And again, we're going to do our best to address those at the end of this webinar or follow up with you via email. Um, yeah, ask your questions. We'd love to answer them. I'm also going to be linking today's slides and handouts in the chat feature once we get started. They're also already uploaded to Zoom and again will be emailed to you in 24 hours. So there's a few ways to get your hands on those. And if you have any issues, just let me know. I'll help you sort that out. And let's do a couple quick introductions. I always forget about this slide, Mike. Okay, and if you love our webinars, but you are so busy that you need to do them on your own time, we do award CPE credit through our pre-recorded webinars, and those are a paid resource. They come with the Salt Vault membership, and you can also purchase them one-off. And again, you can do those on your own time, and they still will award you CPE credit. So please reach out and let me know if you have questions about that, and you can find more information on our website. Um, and at the web address listed. And now I'll do quick introductions. First, for sales tax and more, we are a full service consulting and solutions firm, and we have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services, please reach out and ask. We'd love to work with you, and we would love to hear from you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is uh, very well rounded, and he has helped thousands of companies in all industries of all sizes and is especially well known for his work in the e-commerce industry. And Mike, if you want to take it from here, let's jump in and get started.
Absolutely, Ellie. Thank you for that wonderful introduction. And we're having some technical difficulties today. First, I couldn't even get into Zoom, and now I can't get my camera to work. But I do want to welcome everyone here. We've got a lot of information to cover today, and the big question we're going to answer today is, does a physical presence for sales tax even matter anymore? And I'll give you a little bit of hint. We'll circle back to this, but the hint is yes, it definitely does matter. All right, so what are we going to cover today? We're going to touch on a nexus definition. We're going to go over some court cases. We're going to look at economic nexus so we can compare and contrast. We're going to look at physical nexus. When we're talking about physical nexus, I think there are obvious physical nexus creating activities, and then some are less obvious. We're going to debunk some myths. We're going to touch on some case studies. We're going to talk about how the states find you, and then we're going to answer that question, why physical presence nexus matters more than ever. And as always, the worst time to find out you have problems or your clients have problems is when you're being contacted by the state, whether it's a nexus questionnaire or you're being audited or you're getting a telephone call. Once the state contacts you, a number of the mitigation programs out there are off the table. So if you're being proactive, there are ways to mitigate some of your past exposure. If you're being reactive, usually not so much. So that's why we say the worst time to find out you have problems is after you're being contacted by the state. And Ellie, why don't we go to the first poll question?
Absolutely. That should be on everyone's screen right now. Quick quiz for you. How would you rate your Nexus knowledge? Your choices are what's Nexus, you know, the basis, you have an intermediary knowledge, or you are a Nexus expert, or like we like to say, an expert. And it looks like we have a good mix in the crowd, Mike. I'm going to leave this open and you can move forward. I'll close it out in a minute.
Okay. And for those of you who are beginners, Nexus is just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection that you have to have with the state before the state can make you do anything. For example, before the state can make you collect its taxes, like a sales tax or a seller's use tax, or pay its taxes like an income tax, a franchise tax, or a consumer use tax, you have to have this link or connection that we call nexus. And that's why we say it all starts with Nexus. Because if you don't have this link or connection with the state, if you don't have this Nexus, then the state can't make you do anything. So no Nexus equals no problems and no responsibility. Now, the problem is many companies and sometimes even their advisors, their accountants, don't know they have Nexus. And sometimes they know, but for whatever reason, they decide not to take action. Now, let's go to some court cases here. This is not going to be a deep dive. We're just going to briefly touch on a couple. And these are some of the cases that I think are important to physical presence nexus. Number one here is these are all U.S. Supreme Court cases, by the way. National Geographic versus the California Board of Equalization. This is a 1977 case. And the takeaway from this case is that the taxable activity does not have to be related to the nexus creating activity. So another way of saying this is once an entity has nexus, all business channels in that entity have nexus. And the reason why this is so important, with economic nexus, let's go back a little bit more. When we talk about the pandemic, a lot of companies, a lot of wholesalers and distributors saw that the companies who were selling directly to the public did very, very well, and their business took a big hit. So they all started, not all, but a number of them started selling directly to the public. And they started thinking that, well, it's going to take me a couple of years to get up to $500,000 in a state like Texas or California. Unfortunately, it doesn't work that way because these distributors and wholesalers, they had networks of salespeople all across the country. Now, they never worried about sales tax before because, all of their sales were mostly sales for resale. But rather than wait until it crossed 500,000, it was those people on the ground, that physical presence that meant that they had to start collecting tax from day number one. So in this instance, the wholesale business is the nexus creating activity, but the taxable activity were the sales directly to the consumers. So very, very important and becoming a much bigger issue nowadays. Complete auto transit. I like talking about this because whenever we're talking about e-commerce companies, and there are a number of e-commerce companies out there, and some e-commerce companies do have physical presence also. Um, but the smaller the company, the more they say, and even their advisors say, states cannot tax interstate commerce. Only Congress can regulate interstate commerce. And, if we go back to the 1930s, when the first modern day sales taxes were introduced, they were right. Even the states didn't think you could tax interstate commerce directly at that point. But that started changing in the 50s, 1977. We get this case, complete auto transit. And the takeaway is a state can tax interstate commerce as long as it meets a four-prong test. And it's a pretty easy four-prong test to meet. Now, when we're talking about physical presence, these are perhaps two of the most important cases out there, and hugely important. And out of all the problems in all the years that I've been doing it, doing this. These are the two biggest cases that impact companies. Scripto, they were the pen company. They were located in Georgia and they were selling into Florida using independent contractors. And the state of Florida said the use of these contractors is enough of a significant presence that you should be collecting and paying our taxes. And Scripto said, you're out of your mind. These are third-party relationships. They're true third-party relationships. We don't control their work. We don't control their hours. I mean, we don't do any of this. And unfortunately, the Supreme Court sided with the state. They said that the difference between an employee and an independent contractor is without constitutional significance. In other words, they're doing the same jobs. So that's the first time we see what some refer to as attributional nexus or agency nexus. I try to keep it simple. I call it third party nexus. Now we see this again in 1987 in the Tyler Pipe case. Tyler Pipe, a Texas company. Washington Department of Revenue said, hey, according to the Scripto case, we think that this one independent contractor you got up here in the state of Washington is enough that you should be paying our business and occupation tax. And Tyler Pipe said, oh, no, this is not like Scripto at all. Um, this independent contractor doesn't represent us exclusively. They represent multiple parties, and they're really not very good at their job. It's like having a part-time person. They hardly send us any business whatsoever. Well, it goes to the Supreme Court, and the Supreme Court again sides with the state. And they said that, and I'm paraphrasing here, it doesn't matter what you call someone, doesn't matter how you pay them, doesn't matter if they represent you exclusively or they represent multiple parties. It doesn't matter um, if they do it on a full-time basis or a part-time basis. Here's what matters. Are they helping you to establish or maintain a market? And if they're helping you to establish or maintain a market, then that can create nexus. And the reason why that language is so important is many of the states took that language, establish or maintain a market, and they ran with it. They incorporated it directly into their statutes. They uh, put it into their rules and their regulations. The state courts use it as precedent. So very important language. And, it doesn't make sense to, or common sense to me. If we're thinking about what activities we have that can create our Nexus footprint, we often don't think of the activities of third parties. And that's why this trips up so many people. So many smart people out there don't realize that these types of relationships can actually create Nexus. And we're going to touch on that a little bit more. Final case I want to talk about is South Dakota versus Wayfair. This was a 2018 case. It's the case that overturned Quill and National Bellis-Hess. These were the two cases that talked about physical presence. And when the U.S. Supreme Court decided on this, they didn't say that, hey, times have changed, so we have to change with them. They said we made a mistake. And at that point, it was pretty rare for the U.S. Supreme Court to say they made a mistake. They said that we never intended to create a protected class. We never should have introduced the term physical presence to begin with because we inadvertently created this protected class. So they overturned those cases. It's like they never happened and ushered in what we call economic nexus. And in an economic nexus, no physical presence is required. It can be based on sales. It can be based on transactions. It can be based on a combination of the two. South Dakota thought $100,000 or 200 transactions was fair. The Supreme Court didn't expressly agree with that, but they sort of gave him a wink and a nod. They sent it back to the lower court and they said, hey, you guys work this out. But it got settled before they worked it out. So we're seeing a lot of movement on that 200 transactions. Even South Dakota has backed away from the 200 transactions. Many states no longer have 200 transactions, or they never had 200 transactions. Now, as soon as I say that, everyone starts thinking I don't have to worry about transactions anymore. And while more and more states do away with that every couple of months, we still have about 35% of the states that have this 200 transactions. Some very aggressive states like Illinois, um, and they're enforcing it and tripping quite a number of people up. So we still have to pay attention to transactions in certain states. States don't ever make anything easy. Each state has their own idea of what's included in those thresholds. Some states include taxables, only taxable sales. Some states include uh, all taxable sales, all exempt sales, except for sales for resale. Some states include every single sale. So each state doesn't make it easy. They all have their own ideas as what's included in those thresholds. We're going to look at a chart in a second. That's one of the free handouts today. Um, 2 points I want to make about this economic nexus. Number one, it does not override any other type of nexus. Um, here we are. This was passed in 2018, and I still get calls all of the time. And they say, Mike, I want to deregister in the state of Texas or California. And I say, well, how come? And they say, well, they don't have any transaction thresholds, and my sales are under $500,000 in that state. For the state of Texas, the most recent one, I said, well, last time we talked, you had an independent contractor who was traveling into the state. Oh, yeah, I still have that, but I'm underneath the $500,000. Or in California, well, last time we spoke, you had an Amazon warehouse. And oh, yeah, I still have that, but I'm underneath the $500,000. Oh, it doesn't work that way. I have to break it to them that this does not override any other type of nexus. It doesn't protect you from any other type of nexus. As a matter of fact, a physical presence is going to trump an economic nexus when it comes to sales tax almost every time. Other taxes, not so much. Sales tax, the physical presence is going to trump that economic nexus. Um, so that's something that we must keep in mind. Now, the other one, this is not an internet issue. I mean, my salespeople come to me continuously and say, Mike, I spoke to another account and he says he doesn't have any clients that are subject to this internet tax. 6 years into this, they're still calling it an internet tax. Number one, tax and nexus, two entirely different concepts. One has basically nothing to do with the other. Um, but this is not an internet issue. That's the bigger point. You don't even have to have a website. You can be selling entirely by telephone. You can be selling entirely by referral, by infomercial, by catalog. It doesn't matter how you sell. If you're selling into multiple states, this could impact you or impact your clients. So right now, roughly 40 to 50% of companies out there are still not compliant, or they became compliant. They didn't stay on top of this, and now they're falling out of compliance because it's constantly changing. All right, so let's look at this sheet here. This is one of the free handouts, and we update this every time a state does change something. There's a couple of great columns on here. Number one is the effective date. If you're trying to figure out past liability, what's the date that it became effective? What is the economic threshold? If there's been any changes, sometimes the states will use the old thresholds under the older um, periods and the newer thresholds under the newer periods. Um, what time period is the threshold based on? There's usually three: previous calendar year, or current calendar year, or rolling 12 months. And then what's included, that middle column there, that's, ideal. And I'm going to share something. Every software company out there and every selling platform will tell you we're going to monitor your sales and tell you when you have Nexus. And if you're only paying attention to the software or only paying attention to like Shopify, invariably people come to us and say, Mike, I need to get registered in 20 states. And I say, how come? Well, Shopify is telling me to do so. But Shopify and all of these systems usually don't get granular enough, or you don't put all the information in there so that it can give you the correct answers. Some of them just don't have the ability to be granular enough, and some of them don't have all of the different uh, channels that you sell through in order to make those determinations. If you're going just off of Shopify, though, you're probably going to end up getting registered in too many states because it doesn't exclude sales. I mean, if you have exempt sales, it's counting them. If you have sales for resale, it's counting them. If it's a number and it's running through Shopify, it's counting them. But if you look at this, there's a lot of things excluded on a state by state basis. So this chart is an invaluable tool. The software or Shopify, that's a giant red flag, and it makes you aware of perhaps you need to be looking at this a little deeper. But then you need a chart like this to see if you actually need to get registered, if your specific fact pattern actually crosses the thresholds. And if you don't want to do this, we do have a fairly cheap service at $795. We look at all of your data for the last year plus year to date and see what thresholds you have crossed, and then we make recommendations on how you should move forward. So this also tells you what type of tax you should be getting registered for. And it's not as simple as it sounds. Some states have a use tax, like Oklahoma, rather than a sales tax. It's a seller's or a vendor's use tax that you need to be getting registered for. It's small things like this. And is registration required if all of your sales are through a marketplace? So a lot of great information on this chart. Ellie's going to get it out to you, and it's constantly being updated and on the free portion of our website. All right, so here's myth number one. I don't have to worry about sales tax nexus if I'm under the economic nexus thresholds. And unfortunately, I think that we've shown that that is true because a physical nexus is going to, when it comes to sales tax, pretty much always trump an economic nexus. All right, so let's start talking about physical presence. I've already mentioned you have obvious and less obvious activities. We also have common nexus creating activities and then some very state specific nexus creating activities. When I say a common nexus creating activity, that's an activity that pretty much most of the states, if not all of the states, look at the same way. Where state specific, maybe one or two or three or five states look at it that way. It's definitely not the majority of the states. So let's look at a couple of examples. Real property, whether you own it or rent it, can be an office, a warehouse, a factory. This is something I think that all of us would agree it's pretty obvious. I own or rent an office that's creating some type of link or connection with the state with me. And it's pretty common. I don't know of a state out there that doesn't consider this to be a common nexus creating activity. And that's direct contrast to a virtual office where there's no real property. And people tell me all the time, say, Mike, I don't have any of these links or connections you're talking about. I do everything in the cloud. I have a virtual office. Well, unfortunately, it doesn't work that way. You yourself are actually the link or connection with the state. It's wherever you live or operate your business from. And while this is not so obvious, it is very common. And most of the states out there are going to consider this a nexus creating activity. Employees create a link or connection. I think that if we think through this, we'll see that this is pretty obvious. Even remote employees. Now it got a little bit cloudy during COVID. Everyone was working from home, and a lot of the states said, "Hey, we're going to suspend, these nexus creating activities while everyone's working from home." But hey, the COVID is in the past, and all of those waivers are over. So if you've got remote employees, if they're still working from home, you got to look at that because very common nexus creating activity anywhere you have employees. Now, sometimes the state will say, well, what's that employee doing? And it's going to be based on whether what activities that's doing on whether it creates nexus. But by and large, just having an employee in the state is going to be nexus creating. All right, so independent sales reps. This is that third party nexus we talked about. And it doesn't matter what you're calling them. You can call them manufacturers, reps, independent contractors, subcontractors. Heck, you don't even have to put a label on it. If you have someone performing work for you, that could create nexus. Subject of two U.S. Supreme Court cases. We talked about Scripto and Tyler Pipe. This is by far one of the greatest areas of exposure out there, and it's very common. I mean, you have two U.S. Supreme Court cases. I mean, the states have incorporated this language directly into their statutes and their rules and their regulations. Very, very common. Now, it started with sales. All right. Both of those cases were about independent contractors performing sales activities. But this language, helping to establish or maintain a market, is really umbrella language nowadays. And some states do a good idea of actually saying what they consider to be establish or maintain a market. Other states, not so much. They just figure, well, we'll know it when we see it. And you should know it when you're doing it. But here's a partial list of some common nexus creating activities. I mean, if you're doing installations or implementations, training, any type of performance of services, customer service, collection, credit checking, all of these are things that can be creating this nexus. Now, it's not all third-party relationships. They have to be helping to establish or maintain a market. For example, if you hire someone to develop some software for you and you're hiring them on a 1099 basis, which is how we often pay independent contractors, they're not out there helping to establish or maintain a market. So that's generally not going to be nexus creating. Or you hire a bookkeeper, same thing. They're not out there helping to establish or maintain a market. A rule of thumb that we tell our clients is if you've got someone in the state who is going out and interacting with the public or going out and interacting with your clients, there's a good chance that that is going to be nexus creating. All right, so travel. It's not just where your employees or contractors live, but anywhere they travel on your behalf. Now, sometimes this is very low on a state's radar. Sometimes it's a lot higher. I mean, if something shows up on an invoice, you may show up in someone else's audit. And we're going to talk about how states find you in a minute. But let's say you have a salesperson and they're traveling, between the states. That's not going to show up anywhere on an invoice usually. So it's very low on a state's radar. Now, people tell on each other all of the time. So it's not that there's a 0% chance of getting found, but it's a much lower chance than, if you're reimbursing someone for travel on an invoice and charging them to do an installation. So some of this is very high visibility, some of it's very low visibility, but it's a very common nexus creating activity. Most states say that this is going to be nexus creating. And some states like Arizona and Michigan have very low thresholds, greater than 48 hours cumulatively throughout the year. can be nexus creating in both of those states. So um, it's very, very low thresholds. So Ellie, let's go to the next poll question.
Absolutely. So we want to know, what about sales tax nexus concerns you the most? Nothing you have it down, economic nexus, third parties, travel, or other. And right away, Mike, people are mostly answering third parties, a little bit economic nexus. I'll leave this open again and you can move forward. I'll close it out in about a minute here.
Yeah, those are the two big ones. Third parties, because I just think it doesn't make common sense. If I'm thinking about what activities do I have that are going to create this link or connection with the state, I don't think about third parties. So that's how that one flies underneath the radar. Economic nexus, because it's still relatively new and constantly changing. And then travel. A lot of times the people making the decisions, the sales tax decisions, don't have insight into where people are traveling. So very, very common issues here. Most people answer the same way y'all have. All right, so let's do some case studies. In this case study, there's a specialized software company, and 30 plus years ago, their CPA was the fraternity brother of the owner of this company. And the CPA said, well, Nexus is created by traveling salespeople. So don't let your people travel. You're going to be okay. Well, for 25 plus years, they had no problems until they were contacted by a state who said, hey, we believe you have Nexus in our state. And they told the state, oh, no, our salespeople don't travel. We do everything by phone. They're all in the house here. So we can't have Nexus in your state. This company was in Oregon, and the state of Washington was auditing them. And they said, well, we audited one of your customers and we see that you're being reimbursed for travel. So you absolutely have someone in our state. And by the way, you're charging for installations, which is taxable in our state. So um, the state wanted it and got 7 years of back tax plus penalty and interest. And by the way, the state of Washington has the highest penalty out there, 39% in situations like this. So that's an ouch. This company called me, the president of the company called me, and he was virtually in tears. He thought that they were going to jail. And I had to talk him down off the ledge. I said, listen, no one's going to jail. You can go to jail for sales tax, but it's only if you collect it and don't pay it, usually with intent. But people don't go to jail for just not collecting it. And then he said, well, maybe we need to go to jail. Maybe that'd be the better solution because when our bank finds out about how much we owe, they estimated they owed $16 million across the country. They're going to pull our credit lines and we're going to be bankrupt and I'm going to be homeless. And, if I'm in jail, at least I have a roof over my head and, I've got some meals coming to me. And again, had to talk him down off the ledge and said, listen, there are programs out there that we can reduce that $16 million. Um, so they said, really? I said, yes. They said, well, would you talk to our bank? So had to get on the phone with the bank, and the bank walked us through it, and what was the plan. And at that point, we had a number of amnesties that were also available to them. We said that we had to rewrite some invoices. Long story short, we took this 15 plus million dollar number, we got it down to about $1 million before fees. And I've never seen anyone so happy to pay $1 million in my life. I thought that was, a horrible result, but you got to remember where they're coming from. They thought they were going to jail, then they thought they were going to be broke. And the bank, by the way, said, well, we're in so deep, um, we're going to loan you the money to do the VDAs because VDAs, they limit some of the penalty and back interest. There's a voluntary disclosure agreement is what the majority we did here. And even amnesties, you still have to pay some of the back tax. Um, so that's a lot of money and it's a lot of work. They had to do VDAs and and or amnesties in 40 plus states. Most companies are going to handle, 5, 10 at a time. Once they get that swallowed, then they'll move on to the next 5 or 10. How do you eat an elephant? Well, one bite at a time. So the bank actually loaned them the money so they could complete this process. And, very happy ending there. I thought $1 million was a lot of money. They were ecstatic. All right, so myth number 2, it's never been a problem before, and we've been doing this for you fill in the blank, however many years. It's not going to be a problem now. Those are famous last words. I am contacted by someone pretty much once a month who said, hey, we've been audited 20 times, and this has never been an issue until it is. So you cannot rely, if you're doing something wrong, you cannot rely on past audits in order to ensure that it's not going to be a problem going forward. All right, so ownership or rental of tangible personal property. So if you're leasing something or renting it to others, or if you own inventory or equipment in another state, not only real property creates this link or connection, but the ownership of tangible personal property creates this link or connection. So when you're leasing something, you still own it, and now you own something in another state. Very, very, very common nexus creating activity. Here's a case study. It was a camera leasing company. They were leasing high-grade camera equipment all over the country. State of Massachusetts found them, said they had nexus due to owning tangible personal property in the state. And this company said, we can't be doing it wrong. Everybody in our industry does it this way. And Massachusetts said, well, get us a list of everyone in the industry and we'll go after them also. So they did. And the way we found out about this case is we got a call from one of their competitors after Massachusetts contacted them. They said, hey, can you believe one of our competitors turned this in and said, yeah, it's not infrequent. Since economic nexus, this is becoming a bigger and bigger issue because people hear footsteps and they don't want to be the only one in their industry who is charging sales tax. So with this company here, not everything they were doing was taxable, so we helped them get that number down in Massachusetts. But they had the same problem everywhere. This is a very common nexus creating activity. So we helped them restructure how they were doing things and did a series of voluntary disclosure agreements and got them compliant across the country. Now, trade show attendance. Really, there's 5 different ways that states look at this, and it's going to differ greatly by state. You can attend as a consumer. There's a number of states out there who say that's enough to create nexus. Now, I think it's states would be hard pressed to make that stick. I've never seen a state do it, but they say they can do it. Much more common is if you participate as an exhibitor at a trade show, that's going to create nexus. Now, some states say you can be an exhibitor so long as you don't actively solicit. Very fine line there. But the states make it. If you're actively soliciting, then that creates nexus. Now, some states say you can actively solicit, you just can't take any orders. And then Nevada says that you can sell, you can do all of the above. You can do it as many times as you want a year. But if you're selling and delivering while you're there, you got to collect the tax. And if you do that more than once a year, then that's nexus creating. But if you only do that once a year, it's not nexus creating. So you can just turn that tax over to the show promoter, or when you get home, you can mail in a check and you're done with. But if you do it more than once a year, it's nexus creating. Now, people talk about de minimis activities all the time. The problem is states don't really define de minimis activities on a lot of what they do. This is one of the exceptions. Trade shows, a number of states out there talk about de minimis levels. For example, if you're there for less than 5 days or less than 2 weeks and make less than $100,000 of sales that are attributed to uh, the trade show, then it's not nexus creating. Now, some say, hey, you're at the trade show, it's nexus creating. They don't have any de minimis activities, but a number of states do, and they're spelled out fairly well. This is one that is state specific. It's an example of a state specific. All right, here's another one. This is very common nexus creating delivery in your own trucks. Whether they're owned or leased, whether you have a captive company, whether you have a relationship with someone who does not hold themselves out to the public as a trucking company. In other words, they're not a common carrier. So this is very, very common, and it is nexus creating. Inventory creates physical nexus in most states, whether consigned, stored, or carried by sales representatives. Now, a lot of Amazon sellers made the argument that Amazon needed to be collecting the tax because this was like a consignment sale. You know what? I think that was a pretty good argument, and Amazon should have been collecting the tax and is now doing so. But in a number of states, California especially, consigned inventory. Well, you can't have your cake and eat it too. If you're arguing that this is like a consignment sale, well, that consigned inventory then creates nexus for you. So in California, if you have inventory in an Amazon warehouse, that creates nexus not only for uh, uh, sales tax, but also for their franchise tax. So that's something to watch out for. Now, a number of states have changed since Amazon began collecting the tax. For example, Texas says that if your inventory in the warehouse is only used to fulfill Amazon sales, then it no longer creates nexus. However, if you're using it to fulfill other channels like Shopify in addition to Amazon sales, then that does create nexus. Arizona says if Amazon moves the inventory to Arizona, does not create nexus, but if you ship it directly to Amazon to Arizona, it does create nexus. So that we've seen some movement there, but by and large, most of the states still say that that's nexus creating. So here's another handout. This is the 10 common nexus creating activities for sales and use tax. It's also up on our website. And when we say common, most states, if not all states, look at these as nexus creating. Here are the 12 state-specific nexus. And when I say the 12, there's more than this, but these are pretty common ones. 12 state-specific nexus creating activities for sales and use tax. And when we say state-specific, only a handful of states, or in some instances, maybe even only one state, will look at these as nexus creating. So how do states find you? Number one, auditing your customers. We talked about that, the Washington case study. When an auditor comes out there, they're not just looking at your sales to make sure that you've collected all of the right amount of tax. They're also looking at all of your purchases to make sure that your vendors charge you the tax, and if they didn't, that you've remitted it to the state directly as a consumer use tax. And that's a prospecting tool. Some states very, very formal. The state of Texas, a lead card needs to be filled out for each one of these situations. And discovery units follow up on these lead cards. So you may get a call 6 months, maybe 6 years, but you're on a list, and it's a list you don't want to be on because it's only a matter of time before one of these discovery units does follow up with you. Information sharing with other states or the IRS. Remember, the IRS can give someone a list of everyone in your state who's received a 1099. Then the state looks at who's issued the 1099 and sees if they're registered for other taxes. A lot of times, Amazon tells the states, like California, Amazon tells them who's got inventory there. Web surfing. Some states use software called web crawlers looking for certain terms and make it look like you're doing business in a state. Some states less sophisticated. They have, auditors or other people looking at websites manually, and leads. So every state pretty much has somewhere on their website where there's a hotline you can report non-compliance. Um, some states actually pay bounties for any money that's collected as a result of the tip. So you can have a former employee who not only gets their pound of flesh, but gets paid to do it. Competitors, we talked about a situation like this, could be very innocent. Your customer, maybe they say, hey, my vendors didn't charge me sales tax. Do I need to be paying use tax? And the state says, well, who's your vendor? Next thing you know, you're on a list. And in some states like Utah and a couple of others are purchasing lead lists at this point. So Ellie, why don't we do the final poll question?
All right, trickiest question of the day here, and it's a great time to send in your questions if you have them. And we just really want to know, are you joining us for our next webinar? Mike, I'll leave this open and you can carry forward and I'll close it out in a minute.
Okay. So this brings us to full circle. The big question, does a physical presence for sales tax even matter anymore? And my answer is yes. I think it matters more than anything. And here's a couple of reasons why. Um, Economic nexus. All right. The states are gearing up to track down sellers. They know anywhere between 40 and 60% of sellers are not compliant. Now, they really started making a big push before the pandemic, but it got paused. It's accelerated since the pandemic is over. Um, I think it's going to get pretty ugly out there. States, are looking primarily for economic nexus. They know people are not compliant, but while they're looking for economic nexus, they're going to stumble across all types of nexus. And, it's bad enough if you've been doing something for the last 6 years. I mean, we're coming up on, heck, we're coming up on 7 years of economic nexus. So that's bad enough. What happens if you've had 30 parties for the last 15 years? That's going to be a heck of a lot worse. So the states are going to stumble across all types of nexus while looking for the economic nexus. And some people are predicting we're going into a recession. Some people said that we've been in a recession. I don't know, but I know that states need to make up revenue in a lot of states out there. And historically, when states need to make up revenue, they increase their discovery efforts. In other words, they're out there looking for companies that they think should be paying their taxes. So we got the perfect storm. We know that the states know that a lot of people are not compliant for economic nexus. They're going to step up their discovery efforts because this is a recession. And it's the two things together. It's like throwing kerosene on a fire here. So I think that it's more important than ever. I think that as bad as economic nexus exposure could be, this physical presence, you may have had it for a lot longer. And I think the greater exposure lies there. Although we can't ignore the economic nexus exposure either. Ellie, any questions we have at this point?
We do. Let's jump right in, and I'll just preemptively say if you have to leave right at the top of the hour, thank you so much for coming. Um, Otherwise, Mike, let's just jump right in here. So, if you are looking at an economic nexus in a state that has $100,000 threshold and the evaluation period is current or previous calendar year, is the threshold cumulative or each year is looked at separately?
Well, trick question, like so many questions are. There's a third way. Um, some states, like in Illinois, it's a rolling 12-month period. So there it would be last year and this year. But if they actually say previous calendar year or previous calendar year and current calendar year, each year is looked at separately.
All right, thank you. Okay, next question here. This person wants to know about a training conference. If they sent their staff to a charitable gift planners conference, not exhibiting, but just attending, I think they're wondering if that creates physical presence.
Some states would make the argument that it does. But I think that they'd be very hard pressed to make that argument stick. And if you're just attending as a consumer, you're not doing any exhibiting or anything like that. I have yet to see a state do that. Now, in plenty of questionnaires and surveys, the states say that that creates nexus, but I've never seen them try to enforce it.
All right. Anything else you want to add in here, Mike, in these last couple minutes?
Let's hold on one second. I'll see if I have any other tidbits I want to share. Um, let's talk about some common registration mistakes. So when you're registering, if you find out that you do have Nexus and you're going to be registering for the wrong type of tax, that's why we have the type of tax on that economic nexus chart that you should be registering for. It gets pretty easy to make mistakes. So registering for a sales tax versus seller's use tax or vice versa. I'll give you an example. In Oklahoma, if you register for the sales tax, you also have to register with the Oklahoma Secretary of State. That's a $350 fee. Plus, you have to get a registered agent. That's going to cost you money. You have to renew that annually, and it subjects you to income tax in most instances. Plus, there's a $25 fee to get that sales tax license. Whereas if you register for the vendor's use tax, you get none of that. You don't have to register with the Secretary of State. There's no income tax responsibilities. So it makes a big, big difference. While we're talking about the Secretary of State, um, especially if you have just an economic nexus, you don't need to register with the Secretaries of State. Now, the different websites out there make it look like you have to, but there's a workaround in just about every state out there. So that is something that is often a mistake. We had someone come to us the other day and their accountant told them, well, you need to get registered every state you're in. You need to be registered with the Secretary of State. They only had economic nexus. Just wasn't true. So we ended up getting them deregistered with all the secretaries of state. Now, if you have a physical presence, it's not even required all the time with that, but it could be required, especially if you're paying any type of income tax in the state. Sometimes you have to get registered with the Secretary of State or payroll taxes. So there are times when you need to get registered with the Secretary of State, but for sales tax purposes, not usually. Entering the wrong start date. Some states are pretty flexible. And if you make a mistake, they'll let you go in and change it. Other states say, sorry, you put this in here. Now you got to file $0 returns. I made this mistake when I was first starting out, and I had to file 2 years worth of $0 returns in the state of Indiana. Didn't make that mistake again. It's a pain in the neck. Back then, not anything was computerized. Had to do paper returns for everything. So that's one way to enter a wrong start date is just writing in the wrong number. But another thing, there's a trick question on all registrations. It said, when did you start doing business in our state? And if you tell them, well, I started doing business back in 2017, they're going to say, thank you very much. Now I want the all the back taxes plus penalty and interest from 2017. That's not the question they're asking you. And they hope that you jump to the wrong conclusion. What they're asking you is, when did your nexus begin? So even though you've been selling into the state since 2017, maybe your nexus began last year in 2024. So that's the date you want to use. When did your nexus begin? And here, registering through the streamlined sales tax program before knowing who will do your returns, this is a nightmare. Once you get registered with the streamlined sales tax program, it is like getting jumped out of a gang in order to stop those registrations. And if you're going to Avalara, they're going to convince you to do that. But then you're locked into doing returns with Avalara, and that's a whole nother can of worms we don't have enough time to get in today. But if you want to come with a company like us, we don't use the streamlined sales tax registrations when we're doing returns. There's absolutely no visibility there whatsoever. You don't know what's going on behind the scenes. You can't check it. We can't check it. I just think it's a horrible program. Um, Free is never really free. It either costs you now or it's going to cost you at some point in the future. And that's all I've got, Ellie. So I appreciate everyone joining us today. Thank you very much. I hope that y'all have learned something, and we hope to see you on the next webinar. Thank you.